ladies and gentlemen, today's focus is really quite straightforward, quite simple, and that is that it's easier than ever today to be a successful investor. And I'm going to show that to you by showing you some graphs and some information that will show you how even a good amateur investor could possibly beat Warren Buffett, the great famous investor who's worth almost $100 billion. So let me get the PowerPoint up and running here. So I've titled this, just to be short form, Beat Buffett, How to Generate Better Returns Than Warren Buffett. And the usual disclaimer that nothing in this presentation is advice or recommendation, even if it may sound like it is, and it's for information only. All investing involves risk, and readers must conduct their own due diligence before making any investment decision. So one of the things that you might be interested in is that a few years ago, 7 years ago, in his letter to investors, Warren Buffett gave this advice to the trustees of his estate. He said, put 10% into a short-term government bond index or ETF, and put 90% in a very low-cost S&P 500 ETFs fund or index. So Warren Buffett himself is recommending to the average manager of investments to focus more on an S&P 500 index fund than even his own company. Well, let's see why that's the case. This first chart shows the return of Berkshire Hathaway in the blue line compared to the S&P 500. And here I've used SPY, which is an ETF. And the gold line, which is the ETF, represents the total return. So that means if you took and reinvested all the dividends in a tax-free type of account and just left it there over the 20-year period. And you can see that over that 20-year period, Berkshire Hathaway has substantially beaten the S&P 500. So you're saying, okay, well, Michael, you just said that you're going to show us how you can beat Buffett. Well, watch this. This is the same comparison over 10 years, except this time I've used VOO, which is another S&P 500 ETF. Frankly, it doesn't matter which one you use. And again, it's total return, as if you had reinvested all the dividends in a tax-free account. And look what happened here, that over the last 10 years, the S&P 500, represented here in gold, beat Berkshire Hathaway by a pretty substantial amount, over 50 percentage points. So what happened? Well, let's take a look at another chart here. This is the last 5 years. And again, you'll see that the S&P 500, as represented by the VOO ETF, which by the way is a US dollar ETF. So we're comparing apples to apples here. These are US dollar to US dollar, beat again Berkshire Hathaway quite substantially. And if you're asking yourself why, the answer is that it has to do with Buffett's aversion to technology. So Buffett's mantra is only invest in what you understand. And he's often said, we don't understand technology. The first rule of investing is don't lose money. So he doesn't want to take any great chances and risks. And he tries to avoid dumb decisions. But this uncomfortableness with technology has cost him and cost Berkshire Hathaway quite a bit in terms of performance compared to the S&P 500. So why would you own Berkshire Hathaway at all? Well, for one thing, it's sitting on $140 billion in cash. And they've been building up their cash nest egg for a number of years. And Buffett has been building it because he hasn't been able to find ways to invest it that are acceptable to him. So Buffett is prepared for the next stock market contagion, but Buffett will admit himself that no one consistently is able to predict these markets. So what Buffett has been doing over the past 4 or 5 years with his cash is buying back his own shares. And in fact, some of his biggest investments have been buying back Berkshire Hathaway shares. That's had the result of pushing the value of the shares up, because less shares means more value per share. But he stayed away from investing in some of these very hot companies that have done extremely well and make up a big chunk of the S&P 500. And I'm going to show you a few of them in a minute. So let's start with the first poll question here. And this is something I've asked before, but I think it's worth repeating because we're going to compare index funds to mutual funds. So what percent of Canadian actively managed US stock mutual funds have beaten the market over the past 10 years? Please vote now. Okay, Aaron, I think everyone's voted. So the majority of people, or almost majority, picked 5%. What percent of Canadian active funds have beaten the US market? And 5% is the correct answer. Only 5% of Canadian actively managed US mutual funds have managed to beat the market. And so when we are investing and looking for ways of beating Buffett, we probably want to stay away from these actively managed mutual funds. So here's a chart that shows you exactly what I'm talking about. This shows you the performance of actively managed funds in Canada over a range of different types of investments. And the dark blue line is the 10-year experience. So of Canadian equity funds, 84% underperformed the market. If we look at Canadian dividend and income funds, 91% underperformed the market. And if we look at US equity funds, as we were just saying, 95% underperformed the market. What you'll find that some of the actively managed funds are a little bit perhaps duplicitous in that they're actually what are called Canadian focused equity. So they're primarily Canadian, but they've got some international or US stocks in them, sometimes a fairly large amount. But look, even here under what's called Canadian focused equity, 97% underperformed the market. So that leads us to the second poll question. And again, I've asked this before, but it's worthwhile repeating. By what percent has the US S&P 500 beaten the TSX 250 over the past 10 years? Please vote now. So let's see, pretty evenly split, 1/3, 1/3, 1/3. The answer is 180%. That the US S&P 500 has beaten the TSX in Canadian dollars over the past 10 years, 180%. So the purpose of this is to explain to people why you need a diversified portfolio, including US stocks. And again, we'll look at this in a minute, but if you think of the companies who have really been the star performers in the world, almost all of them are from the United States. So this chart compares the S&P 500 represented by the XUS ETF, which is the S&P 500 in Canadian dollars, total return, compared to XIC ETF, which is the TSX 250 again in Canadian dollars. And you can see over this 10-year period the difference. So the TSX has returned 111%, and ex-US, the US ETF has returned 284%. Now, a number of people are asking, particularly after the last couple of days, is this a time to own stocks? Are stocks overvalued? And I did a little checking yesterday just to answer. And I realize this is a bit of a busy graph, but if you look at this right-hand column, this is what's called the PEG ratio. And it is the ratio of the price to earnings ratio divided by growth. And it's a good way to measure if a stock is expensive or not, because essentially what people pay for in a stock is the future growth. And the value of a stock is nothing more than the present value of its future earnings. So the PEG ratio, and I won't go into it too much, is a good evaluator of the relative value or expense of a stock. And so I've listed these in order of this PEG ratio number. And interestingly, of the ones that I looked at, and this is not an exhaustive list, Apple came out number one, despite the fact that Apple has gone up incredibly in price. And by the way, Apple is Berkshire Hathaway's biggest holding with, I believe, something like $140 billion worth. But if we look at Apple, just comparison, its price yesterday was $142. When I do a present value calculation of its future earnings, I get a present value of 218. The Buffett rule is to buy at 70% of present value. He also calls it intrinsic value. It's basically the same thing. So 70% of 218 is 153, which is interesting because that's higher than its current price of 142. Its 52-week high was 157. And a spot that I find interesting to look at stocks is when they're at least 20% below their 52-week high. Now, again, I'm not making any recommendations here. This is just for information. A second stock that I looked at was Canadian Tire Corporation. And there was an article, I think, in one of the media today, talking about Canadian Tire being a severely undervalued stock. And you can see that its price to earnings divided by growth ratio is 1.4. I did a present value calculation. I came out with a really surprising value of 385. And you can see the buy at is about 269. It's currently at 186. So I did it for others, Amazon, Microsoft, Google, Canadian Pacific. And essentially what it told me when I looked at these is that if you look at the net present value here that I calculated and their current price, these stocks are not particularly overvalued. Now, I don't know if that applies to the whole stock market, but these are some of the biggest names in the S&P 500, particularly Apple, Amazon, Microsoft, and Google. And they don't seem to be really stretched in value. And I was quite frankly surprised to see this. Now, if we go down here to some of the others, just to make the point, there's a couple that do seem to be pretty expensive. Costco, for example, is currently selling at about $447 a share. I calculated its net present value to be 324. And you can see its PEG ratio is quite high at 3.4. And this proves the point that a great company is not necessarily a great stock to buy. I love Costco. I think Costco is a fabulous store. But obviously, they don't make a huge amount of money relative to their stock price. And then I threw in, just for some local flavor, Shopify. They're currently selling at about 1735 Canadian. I calculated its present value at 416 and its PEG ratio at 11.4. Anyway, all to say is that Yeah, there are some stocks that are very expensive, particularly those that have been favorites during the COVID crisis. But a lot of the stock market, a lot of the big names are not crazy. So what does that mean? Well, it means that looking long term, buying something like an S&P 500 fund, holding it for the long term, reinvesting the dividends, can be a good way to develop substantial wealth. So here are three examples. These are S&P 500 ETFs that are available in Canada in Canadian dollars. So you buy them in Canadian dollars. And I just picked three. They're all very similar, as you can see. FV is from Vanguard, XUS is from BlackRock iShares, and ZSP is from BMO. You can see the yield's about the same, the MER is about the same, and they perform very similarly. Then here are three that are US dollar denominated S&P 500 ETFs. And the main difference here is you can see the yield a little bit higher and the MER is a little bit lower. Some of these are down to 0.03. That means that on a $10,000 investment, you pay about $30 in fees per year. And this is one of the reasons why it's very hard for actively managed funds with 2% or so MERs to beat these index ETFs. So just keep that in mind if you're going to invest in the S&P 500. So how do you do it? How do you buy these? Well, fee-free online brokers are a good way to start. And in Canada, there's Questrade, Wealthsimple. BMO InvestorLine now has some ETFs, mainly from Vanguard and a few others that are no fees are charged to buy or sell. And National Bank has recently come out with no fees on, I believe, any of their purchases on their online direct investing account. In the United States, some of the keys are, let me go back. Some of the key providers are Robinhood, Charles Schwab, and TD Ameritrade, all of whom are fee-free today. So that means you can buy and sell as much as you want and you don't pay a cent in commission. So in addition to very, very low fees, you also have very low trading costs. So two options for people who want to beat Buffett. So for long-term growth, capital gains, we're talking here 10 plus years, hold a diversified portfolio of mostly stocks and do nothing except reinvest the dividends. For income people, invest in cash generators that are going to be less affected by market downturns and focus on tax-advantaged Canadian dividends. So option one for long-term investors, buy a US stock ETF from a no-fee online broker, invest a fixed amount monthly, reinvest the dividends through a DRIP. Remember, a DRIP is a dividend reinvestment program that is set up at no cost to you by your broker, and wake up rich in 20 or 30 years. So if you've got, children or grandchildren and you want to help them invest for the long term, you follow Warren Buffett's advice, invest in a low-cost S&P 500 ETF. And just to show you how this has worked, and again, I know I've shown this chart before, but this shows the period going back to 88, and the red line is the S&P 500. And you can see that there was a long period of time for about 2000, right over here to 2012, where the S&P 500 actually didn't gain anything. But just by reinvesting dividends, which is the blue line, over that period, same period of time, the person who reinvested dividends made about 50% or more on their money. Actually, I'm just looking at it here. They made about 100%. So it went from 1,500 here to almost 3,000. And they did nothing more than reinvest the dividends in a tax-free account. So last poll question, how much is $500 a month invested in an S&P 500 ETF worth after 30 years at the average annual return of 9% with reinvested dividends? Now, I know this is a trick question, but so how much would the $500 a month be worth after 30 years? That's what you would put in over time at a fixed amount. If you just looked at 9% per year without reinvested dividends, that would be worth $922,000 after 30 years. But with reinvested dividends, it would be worth well in excess of $1 million. It's impossible to calculate accurately because it depends on the ups and downs of the market and when those reinvested dividends occurred. But it would be, as we saw from that previous graph, well in excess of the value of the basic S&P 500 index. So again, the lesson here is, particularly if you're investing for the long term or know someone who is, put it into something like an S&P 500 ETF and reinvest the dividends and just leave it. So option 2 for income investors, just again to mention, because I know some of you are, this may not beat Buffett, but at least it will give you good, solid income, and particularly given the volatility we've seen over the last few days, stick to dividend and income ETFs, 4+% distributions, inflation protection, reduce risk, and you get tax advantage dividends. Remember that 4% dividend typically in Canada is equal to about 5.2% interest in a taxable account. And as you know, there is no place in the world to get 5.2% interest today. The other thing I want to remind you is a little gold. Gold's been beat up lately, but gold does well when real interest rates are negative, which they are today and seem likely to stay that way for some time to come. Gold also does well when stock markets decline and when central banks print too much money. And I would suggest that all three of those situations are occurring today. So finally, disclosure, the author owns the following investments. I, like Alain, own Berkshire Hathaway, and I keep it because of his preparation for what may happen when the stock market may hit an inflection point, and also own VOO, the US S&P 500 ETF. And let me conclude by now just reminding people that I have a YouTube channel called Secure Wealth, where I'll post a video of this presentation, as well as other videos that I'm working on. And one that I plan on doing is one that explains that chart that I showed you earlier about how do you calculate the present value of a stock, which gives you some idea of its value. And with that, I'll turn it over to you, Alain.